This video was created using artificial intelligence to offer an accessible overview of the latest global economic events. The content does not constitute financial advice. The United States national debt has reached a historic high, over $35 trillion and still climbing. Congress is now forced to vote almost every year to raise the debt ceiling. If it doesn't, federal institutions shut down, and pensioners and public servants may go unpaid. Trump says this can no longer continue. His answer? Tariffs. Not only does Trump use tariffs to protect domestic industry, he also treats them as a tool to stabilize public finances. More revenue, fewer imports, more jobs. That's Trump's economic formula. Unless you're shorting the market, the recent market turmoil likely caught your attention. Trump has launched a new trade war, and markets are not taking it lightly. Stocks are plummeting, and investors are panicking. But what's behind these new tariffs? Are they just a campaign tactic or the start of a real global economic restructuring? On April 2, 2025, President Trump declared Liberation Day, imposing sweeping tariffs on nearly all of America's trading partners. In addition to a general 10% import duty, he introduced country-specific higher tariffs across multiple regions. China was hit the hardest. With existing tariffs included, the total tariff rate on Chinese imports climbed to 104%. Beijing retaliated by slapping a 34% tariff on U.S. goods, further escalating tensions. But it wasn't just China. The European Union now faces 20% tariffs, significantly impacting European exporters and US-EU trade relations. The EU responded diplomatically. Ursula von der Leyen, president of the European Commission, proposed a zero-for-zero agreement. Both sides would eliminate tariffs on industrial goods, including automobiles. Trump rejected the deal outright. Not enough, he said. Instead, he demanded the EU purchase $350 billion worth of American energy, gas, oil, coal, if they wanted any tariff relief. World leaders expressed alarm. The EU considered retaliation, while Japan and South Korea hinted at similar countermeasures. Markets panicked before the rebound. The S&P 500 dropped over 1.5%, and some Asian exchanges fell by as much as 3%. Investors feared that Trump's tariff war could push the world into a new recession. The rapid mood swings showed how fragile confidence remains. Markets are balancing between hope and fear. On April 9th, at 9:37 in the morning, President Trump posted on Truth Social time to buy DJT. The timing definitely raised some eyebrows. Markets were already falling sharply after his earlier announcement of sweeping new tariffs against nearly every country. The new structure signaled rising short-term costs for importers, especially in industrial and tech sectors. The initial market reaction was striking. The S&P 500 dropped over 3%. Asian markets, particularly Japan and South Korea, fell nearly 4%. European indexes like the DAX and CAC 40 dropped more than 2%. Prices of industrial metals, including copper and aluminum, began to fall. But then, just 4 hours later, Trump reversed course. The global tariff package was suspended for 90 days. A general 10% tariff would still apply to most countries, while additional targeted tariffs would be imposed on China. The market response to this reversal was swift. The S&P 500 and Nasdaq rebounded, recovering nearly half their losses. The volatility index, or VIX, spiked, then calmed. The dollar strengthened initially, but then weakened. Meanwhile, the Chinese yuan and Hong Kong market remained under pressure. Analysts were quick to call this back-and-forth destabilizing. Investors struggled to price in such erratic trade policy. All eyes are now on the next 90 days. On April 9th, in a surprise move, Trump paused tariffs on most countries for 90 days, but raised them on China to 125%. The official reason? Over 75 countries had pledged to negotiate and not retaliate. In contrast, China's response and ongoing trade imbalance called for harsher measures. Markets soared. The S&P 500 surged by 9.5%, and the Dow gained nearly 8%. Some analysts even said it was a golden opportunity to take profits, especially in tech stocks that had dropped heavily the week before. The very next day, markets reversed. The S&P 500 fell 3.5%, and the Nasdaq dropped 4.3%. The Dow plunged over 1,000 points. Analysts pointed to profit-taking and persistent concerns about Trump's tariff flip-flop as the main culprits behind the sell-off. On April 11th, U.S. markets rose moderately, continuing the rebound sparked by Trump's suspension announcement. Still, uncertainty lingers. Investors are closely monitoring developments, especially any further escalation with China. We'd love to hear your thoughts. Where do you think this is all heading? Spoiler alert. I sold everything during the big rally. I exited this unpredictable US-China tariff situation and locked in profits. The massive surge caused by Trump's post felt like the perfect exit point. But don't be misled by the impressive gains I'm about to show. These were only possible because I previously accepted significant losses while waiting on China's response. I broke that down in detail in my last video. Why exiting may have been a mistake. I could miss the upside if US-China talks progress. A single positive headline could spark another rally. Even slow gains could leave me behind while I sit in cash. I may have overreacted. The market might handle these tariffs better than we think. Why selling made sense. Realized profit is real profit, especially in volatile markets. The surge felt overdone. A pullback seemed likely. Bad news could hit any time, and there's still no clear deal with China or others. China's stance is hardening tensions, diplomacy, potential retaliation. I'm now liquid and ready to re-enter if a better opportunity comes. This isn't a forever hold. It's a trade. Beating the S&P 500 long-term means knowing when to wait. In the end, the arguments for selling felt stronger. Of course, I'm not a prophet, I might be wrong. If a breakthrough deal is announced next week, well, yeah, that would suck. But I made this decision based on what I knew at the time, not hindsight. Conception. Sold. Summarize. Disclaimer. Taxes, broker fees. What about you? Did you seize the opportunity or take a different approach, maybe even reshaped your portfolio? Let us know in the comments. Thanks for tuning in today. I'll see you in the next episode. Until then, take care and stay sharp. The information presented in this video is for informational purposes only. It does not constitute investment advice, financial recommendations, or a solicitation. All investment decisions are solely the responsibility of the viewer.